Welcome to another episode. My name's Martin Bennett, CEO, founder of The Loan Room. Listen, understanding how you should borrow, how you should structure your finance can be very frustrating. But today we're going to map out when you should do each of these different structures based on the quite boring answer, your personal circumstances. So let's get into it. So what you're going to learn today is the importance of what entity you should get your loan in, how to structure it best for your personal cash flow circumstances, and how to make sure you can continue to borrow and build out your portfolio while not being short every month from a cash flow perspective if there is a shortfall when initially building out that portfolio. One of the first things you need to understand when it comes to property investment and it comes to finance, and this is where so many people get it wrong because they don't understand debt and inflation. First of all, the reason property is such a powerful investment tool is because of the leverage you can get on it. So over time, it's not just about the property increasing in value, it's that the debt becomes worth less and less as time goes on due to inflation. Now, where we're sitting right now, we've just had an announcement that inflation has gone up by, I believe, 1%. This is great if you're a property investor, bad if you're not. So understanding, first of all, the purpose of debt is to create wealth through leverage in real estate, and you don't necessarily need the property going up in value. It's over time, again, the debt becomes less valuable due to inflation. So the debt actually erodes with time. So when starting off with your real estate portfolio, clarity is key. Understanding where you are today and where you want to get to allows you to work with a professional to set up those right loan structures. For example, if you're a high income earner, you get your job from wages, quite often it can be very beneficial to perhaps buy a couple of properties in your personal name, depending on your long-term goals, because that allows you to have an instant negative gearing or tax savings on your personal income. What we tend to find is though, if you have large goals or your income won't actually allow you to borrow enough money, then we start looking at other structures. Structures such as buying in trusts, buying companies, or looking inside of your self-managed super fund. Each entity and structure has its pros and its cons, and it's purely based on your individual circumstances and where you're trying to get to. Let's have a look at where it may make sense to buy in your personal or individual names. Is if you're a high income earner, you have other assets and you're not looking to scale out a large real estate portfolio, but you have a big tax burden every year, and you might have a goal to get to 2, 3, 4 properties. Your personal income allows that, and so you want to take advantage of depreciation and negative gearing against your own individual income. That can make a lot of sense for you to buy in your personal name. Where it makes sense to buy in a trust is, let's pretend you want more asset protection, security for your family, and you want to be able to grow larger than what your personal income may be actually allowable from the lending perspective. This is where we'd actually look and say, is it worthwhile buying in trusts first to maximize your borrowing capacity, and then after your income's maxed out, buying inside of your individual name where you can then also get some personal and negative gearing benefits to reduce your taxable income. In these circumstances, this is where we clearly work with your accountants and help you map out that efficiently. Lastly, buying inside of a company. This is something that I do, is that because we make company profits, I'm able to distribute that profit into a bucket company that owns part of my business and only ever pay 25% tax on the dollar. Whereas if I was to transfer that money out into a family trust or to my individual name, I need to pay the highest tax bracket, call it 47%. So I'm paying over 20% extra in tax to get the money outside of the business instead of saving that money and being able to accumulate it faster. There's downsides to that too, because buying inside of a company, you don't get any capital gains exemption. So you roughly pay about an extra 6% tax on the sale of an asset if you were to sell. But everyone's different. The way I look at that is I'd rather be able to accumulate at 25% and not worry so much about the 6% extra when it's time to sell. Right now, however, there's a lot of changes going on in that space due to lenders changing policies around trust and company lending. So you may be forced to pay a slightly higher interest rate and fees when looking at that type of structure for your portfolio. However, if it helps you to achieve your long-term goals, which is what property should be doing, the short-term cost should not outweigh you being able to achieve your long-term sustainable goals with your real estate investment. If you do want to buy some properties inside of your personal name to get rid of some of those tax burdens you may have from a high income or job, quite often it's actually easier to do that once you've built up your trust lending and then buying your personal name, because it frees up your borrowing capacity and serviceability along that journey. So we used to see a lot of people come to us, they'd maxed out their personal borrowings in their own name, and they're like, Martin, we've heard we want to buy in trusts because we can borrow more money. Yes, that's true, but it needs to be done the reversed way. First, you fill up the trust, and then if you want to, you buy in your individual name based on your current tax circumstances and your long-term wealth creation goals. So how and when should you access the equity to allow you to continue to accumulate assets? Well, the way we look at it here in the loan room is if you have your principal place of residence, you want to look at the fast track strategy to enable you to use debt recycling by eliminating your non-deductible debt first, then continue to access equity from inside of your principal place of residence. Because as your owner-occupied debt lowers, it allows you to increase your tax-deductible debt. You always want to be accessing equity ahead of time though. And the reason you want this is for an opportunity comes up, there's a downturn, you need capital to be able to hold properties for a season because some unforeseen circumstance happens in life. So always be prepared well and truly in advance for asset protection, for serviceability, and for opportunity that may come around. Well, let's look at where we see most people get trapped. It's the people who have already done the right things, but maybe in the wrong sequence. They've gone out, they've bought 1, 2, 3, 4 properties, and they've done them all in a simple methodology where they've just bought in their own individual name. The trap here for them is that they max out their borrowing capacity. You see, one of the greatest things with buying through companies or trusts, it's the ability to borrow more money and not get stopped due to borrowing capacity. So the number one thing we can really say is that to avoid this happening to you, if you really want to grow out, is make sure you put a pause on buying property, understand your structure first. How should you buy those properties? In what finance structure and entity should they be bought in? Because mapping this out first actually enables you to go through year on year and build your portfolio without any hiccups or being caused due to, I can't borrow enough money anymore. Wow, I wish I had done this differently, because changing what's already set up is very, very costly. So how do you avoid all this happening? You're wanting to get into property investing. You understand the long-term wealth creation it can provide for you. How do you know what is right for you? It's quite simple. It's sitting down with somebody like myself and my team here at the Loan Room, working out what your goals are. Let's pretend you want to get to 10 properties. We then run the borrowing capacity on you as an individual, and also then look at, well, what happens with the variances if you buy some in a trust, some in a company, and some in your individual name. So before you actually buy anything, you already know, is it feasible to actually get to your goal? Because there's no point starting and embarking on a journey if you don't know you can actually achieve what you want to achieve in the first place. So to avoid this, sit down with somebody who understands how to get you there, then work through, well, what entity, what structure should be done for each property prior to you ever buying it. This allows you to continue to grow and build that momentum and hit your wealth creation goals that you're really after. Let me give you an example. So we have John and Mary sitting down. Let's use the 10 property example. We get all their financials. We understand their living costs, their income, their future. Are they going to have another child, etc.? So we can map all of that out. And then we'll work through and say, based on each acquisition, where can you potentially get stuck? For most people, it's either not enough equity or not enough serviceability. We can then build out a calculator to show at which stage should you buy in your own name, at which stage should you buy in a trust, super fund, or other entity, and where the breaking point is from serviceability. Because you don't buy each property necessarily in the same structure. You buy it that allows you to get to the next one, and then the next one to eventually build out your goals. If anything we've spoken about today resonates with you, whether you're starting your journey, whether you're finding yourself stuck, hey, listen, make sure you reach out to us. We service clients Australia-wide. Book in a short 30-minute strategy session, and we'd love to help.